Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our FSC show, so we're going to cover what's happening on the completion side, rigs, and then a quick roundup for some of the recent data that came out for both the US and China, just because it's important given obviously demand on where demand is going, and just where's the consumer. And I think that's the biggest piece, because the consumer is the one that's really starting to show the cracks at this point, as we've already talked so much about real estate. But one of the key pieces that we wanted to highlight is we did have the special report from Russia. So far, everything we said has come true. You know, they've ratified the vote, recognizing the additional 2 areas in the Ukraine. We went through the Nord Stream 1 and 2, you know, that's coming out that it was sabotage. I don't think anybody questioned that. It was just a matter of who did it, like where was it done, and we talked about that more in our insights that are coming out today. So we did do a lot of that, so there's no need to go crazy. You know, we have, if you go back to yesterday, we did a Russia special episode. We also talked about Iran. The Iranian protests continue to intensify, so we talked about that yesterday. So please go back and watch that video. And then we also did the Econ show, covering a lot of the things that we've been talking about. And unfortunately, I wasn't able to cover in full just because we were traveling, but now I am back. With that being said, let's get to the frac spread count, where we had an increase of 2. So we went from 288 to 290. And one of the reasons why we named this episode, if you will, U.S. activity holds strong against a weakening economy, is because, as we've been saying, this is going to look a lot like the 70s, where you have a really weak economy, things are struggling, but there's still shortages in the market. And when you look at natural gas specifically, there is a very healthy market. When you look at oil in general, there is a very healthy market due to the problems that are happening between Russia and Europe. Where is that crude going? Where is it available? And so I think those are some really key pieces when you look at what is happening in general. So with that shortage is why you're going to continue to see 3.7 million barrels a day of U.S. crude going into the market. You're going to continue to see 6 to 8, depending on whenever Freeport comes back, million tons of LNG moving into the market. And that's going to support activity. So yes, you'll have prices that'll bounce back and forth. And while the NGL basket has come under pressure due to the slowdown in petrochemicals, which is going to essentially put a little bit of weight on where that pricing is, it's going to make margins much worse on the petrochemical side. So we still remain concerned on the petchems, but the export market still remains open for U.S. NGLs, which again is going to support the activity that we have right now, and puts us right in line to make that final push. With that high being about 300, we're closing out September at about 290. About 5 below where we thought we were going to be, but still very much right on pace, with some of the growth continuing to be in the smaller regions, but Appalachia is starting to pick back up, which is very normal for this time of year, given the need for natural gas. Now, when we look at rigs, you can see that there was an increase of 2 oil and 1 decline in gas. But when you look at it, there were 3 horizontals that came on. 2 vertical went down. So the horizontals continued to be the upward momentum. And we're seeing a lot of that activity being cycled around the both New Mexico, which has continued to really outperform a lot of the other areas in terms of activity. And then I just wanted to pull up, because there was another one that was interesting, and West Virginia. So you had New Mexico with an addition of 2, North Dakota addition of 1, but West Virginia an addition of 4. So again, we're really starting to see that ramp from the natural gas perspective, which makes sense given where we sit today in terms of storage, where LNG is going, and just where the natural gas curve sits. So there's a lot of reasons to see some of that activity continue to pick back up, which is being supported by the frac spread count. Now, when you look at the U.S. Drought Monitor, things continue to get a bit worse. It's putting a lot of pressure in terms of just the yield, what that yield looks like, where there's more pressure to come when we're just looking at timing. And I think that's the biggest piece, because none of this appears to be going away anytime soon. And that's, I think, the biggest struggle point in terms of when does that go away? How does that go away? Does it go away at all? Because the past years, hard red wheat crop was the smallest since 1957, and you're continuing to see a lot of those pressures. So Argentina's wheat condition continues to suffer due to drought. We've been talking about that. That is something consistent. But then when you look at the U.S., we're not much better, especially when you look at the heartland, where we're going to see a lot of these impacts to drought, which is continuing to hit other places, which is why we make the comment back to the 1970s of, even as demand shrinks, there's a supply problem, and it's hitting multiple commodities, not just one, which is why even as demand falls, where is supply? How is that kind of battling it out when you look at that slowdown and you look at where some of those prices have shaken out? Now, when you look at some of the recent updates for the U.S., personal income came in at 0.3, personal spending at 0.4. But the biggest concern when you look at the real personal spending is fairly flat, but look at the PCE deflator, which is what the Fed relies on when they're looking at where is real inflation, where is it really hitting the economy, and it's at 6.2%. So it was expected to be at 6%, came in at 6.2%, and you saw that acceleration, and we're tracking another increase in September, and this does not include the slight increase that's happened in gasoline. This does not include the electricity bumps that we're seeing, the heating oil increase in price. So there's a lot of momentum that remains behind this, which is why we see that additional the continuation of inflation, which is going to put even more pressure on the consumer, which is obviously being reflected as well in the University of Michigan sentiment coming in at 58.6, missing estimates, expectations coming down as well. So again, you're starting to see that bleed down. But the Chicago PMI was the biggest, I think, shock for me, where it was expected to be at 51.8. We were expecting to see something about 50, 40, like very mediocre, but nothing too far down. But here you can see that there was a drop to 45.7, which is sizable. I mean, that's not 49.5 where it's slightly down, but not as bad. This is a meaningful drop. And again, that's where you're seeing some of that acceleration to the downside. And China was something similar. So when you look at the composite for PMI, came in at 50.9. Manufacturing, which is what we've been saying, is going to be fairly flat. Not robust, not a huge drop. And here the expectation was for 49.7, came in at 50.1. It was the non-manufacturing that we've been discussing, where the non-manufacturing was where we saw the bigger slowdown. And here the expectation was for 52.4, came in at 50.6. That is a meaningful drop. And again, pointing more towards the consumer and the pressure there. And then when you look at the Caxton, which was expected to be at manufacturing, it was expected to be at 49.5, and it came in at 48.1. So again, you're seeing the pressure to the downside, and it's just going to be a matter of who was asked, when they were asked, and that's where when you just look at the data in general, it is not showing strength or expansion, but really a sideways, and when you factor in other data sets, really a move to the downside. So then I thought this was a good summary that these guys put out, Nordea, is when you put it all together, when you look at, stocks still have further to fall when you look at the U.S. corporate 10-year triple B rates, when you look at U.S. CEO confidence, things that we talked about yesterday, when you look at, where is the earnings discount, where is the earnings, the central bank moves, or what are the expectations for where we are. And there's still a lot of froth in the market, which sounds crazy for those that have felt pain based on the volatility, the movements lower, but we still haven't seen that maximum. And that's, I think, one of the biggest issues when you look at some of the data sets here. Then when you drill in a bit, you can see, again, August PCE inflation still running hot, came in at 6.2% versus the estimate of 6%. And last month was 6.4%. But again, you're still missing estimates. You're still running hotter than expected, with core coming in at 4.9% versus last month's 4.7%. So on the core side, you're actually accelerating, which is what we've been talking about. When you look at core, when you look at trimmed, when you look at mean, all of these are showing that the core side of the inflation equation is going higher, and there's more pressure behind it, which continues to play out. On the spending side, consumer spending came in at 0.4 in August, inflation adjusted at positive 0.1. But one of the things that we were saying was that August was going to kind of be that last good little bump as people go back to school. You get some of that move in. But now, as we go into September, we actually see things getting worse. So you have a little bit of a bump, and now we think September is where you see that decline, which accelerates from September, and it continues to get worse October, November, and really starting to bottom out in that December period. And we do think it gets worse in 2023, but again, it's all gradual and then all at once. And based on the trucking data that we discussed yesterday in the Econ Show, segment 1, is we're seeing that, again, that bigger slowdown in terms of rates, in terms of cargoes, and that is a bigger problem. August personal income is expected at 0.3, came in at 0.3. Personal spending was expected at 0.4, came in at 0.2. So again, you're still seeing some of that stickiness on the consumer side, but this is where we do see that biggest pressure to the downside. And then when you look at current auto inventories, I thought this was just interesting. Our auto inventories are above their 12-month average by 14%, which is the highest going back a few decades. Conversely, ex-auto inventories are still high relative to their 12-month average by about 8%. But have started to roll over and normalize as you get some of those discounts that have come through, and that has helped support some of that consumer spending. But as inventories normalize, you don't get those same type of benefits, and that's when you get that bigger drop, which is what we're seeing now. So that's what we have for you today, keeping it a little bit short just because we had a lot of shows that came out this week, back to the normal process. And hopefully you have a great weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.